Have you been wanting to invest in the stock market but found the process overwhelming? In this video, we'll break down the fundamentals of choosing stock using Charlie Munger's tried and true strategies. We'll also give you essential tips to empower you to make informed investment decisions that will pay off in the long run, even if you're starting with just a few $100s. And that's not all. We'll also be sharing bonus tips at the end of the video to help you take your investing game to the next level. Whether you're a beginner or an experienced investor, there's always more to learn. So stick around to the end and get ready to boost your investment knowledge. Step 1. Understanding investment strategy. There are 4 essential strategies to make a successful investment. First, invest in quality companies. According to Charlie Munger, vice chairman of the Berkshire Hathaway, it's more important to invest in quality companies with a strong competitive advantage and a long-term sustainable business model, rather than just buying stocks at a low price. Buying a company at a significant discount won't result in a significant return if the business only makes 6% on capital return. In contrast, paying an expensive price can lead to great returns if the corporation earns 18% on capital over a 20 or 30-year period. Coca-Cola is a primary example of a company with a consistent track record of providing excellent returns to its investors, primarily due to its outstanding return on invested capital, or ROIC, which measures how efficiently a company is using its capital to generate profits. Take Coca-Cola for example. In 2020, Coca-Cola had a net operating profit after taxes of an estimated $8.6 billion and invested capital of approximately $39.9 billion. This gives us an ROIC of about 21.5%, 8.6 billion divided by 39.9 billion. This means that for every dollar of invested capital, Coca-Cola generates an estimated return of 21.5 cents. This is an impressive ROIC, which indicates that Coca-Cola is effectively utilizing its invested capital to generate profits for its shareholders. Investors often look at a company's ROIC as an important performance indicator when deciding whether to invest in a stock. A high ROIC can indicate a company has sustainable competitive advantage, which can lead to long-term profitability and growth. It's important to remember that a low stock price does not always translate into a smart purchase, and stocks may trade at a discount for a reason. The next is to avoid costly mistakes. Mistakes can be costly and negatively impact your returns, so it's essential to learn how to avoid common investing mistakes, such as making impulsive decisions based on emotions or failing to conduct proper research before investing. The third strategy Munger advocates is prioritizing microeconomics over macroeconomics. Macroeconomic factors such as interest rates and GDP growth can be unpredictable and fluctuate rapidly. Instead of focusing on these factors, Munger and Buffett focus on investing in excellent enterprises that generate profits regardless of macroeconomic conditions. And finally, the fourth strategy is to diversify your portfolio without overdoing it. Munger suggests diversifying your investments to reduce risk, but cautions against over-diversification, which can dilute returns. He recommends investing in a small number of high-quality companies rather than spreading your investments too thin. Step 2. How to select a brokerage account for investing. After understanding the basic strategy of investing, the next step you should consider is choosing a brokerage account. A brokerage account is a contingency reserve that an investor uses to purchase and trade securities such as stocks, bonds, and mutual funds. The right brokerage account can help you make smart investments, avoid losses, and maximize profits. When opening a brokerage account, you need to go through an online registration process, and the minimum investment requirement varies for different accounts. Funding the brokerage account can be done through various sources, including bank transfers, credit or debit cards, and wire transfers. Be sure to understand any and fee structures as it applies to your account and investment strategy. Some of the popular brokerage accounts include Fidelity, TD Ameritrade, E-Trade, and Charles Schwab. Step 3. Understanding stock and mutual funds. The third step for investing is to understand various investment options, such as stock and mutual funds. If you bought stocks, it means you had purchased a small piece of ownership in a company. When a company performs well, its stock price can increase, providing potential gains for you. However, it's important to remember that there are risks involved, and stock prices can be volatile. As a beginner, it's best to stick with stocks of well-known companies that have a solid track record, such as Apple, Microsoft, or Coca-Cola. Mutual funds, on the other hand, are a type of investment vehicle that pulls money from multiple investors to purchase a portfolio of securities such as stocks, bonds, or other assets. The fund is managed by a professional portfolio manager who invests the money on behalf of the investors in accordance with the fund's investment objective and strategy. Mutual funds offer several benefits, such as diversification, convenience, and flexibility. There are many types of mutual funds, including index funds, actively managed funds, and exchange-traded funds or ETFs. As a beginner, you may want to consider investing in index funds, which are a type of mutual fund that tracks a specific market index, such as the S&P 500. Step 4. Determining how much to invest. The next step you should consider is to determine how much you can afford to invest. Consider your income, expenses, and any other financial commitments you have before deciding on an investment amount. It's also worth noting that investment in the stock market comes with risks. You could potentially lose money if you invest in the wrong stocks or don't diversify your portfolio. That's why it's crucial to set a budget for your investments and stick to it. One commonly used benchmark for investment budgets is the 50-15-5 rule. This rule suggests that 50% of your income should go towards necessities, 15% towards retirement savings, and 5% towards your investment portfolio. Of course, this is just a starting point, and you should adjust it based on your own personal circumstances and financial goals. Step 5. The importance of long-term investing and how to do it. Long-term investing is an approach where you buy and hold quality stocks or bonds for years or decades. This contrasts with short-term speculation, which involves buying and selling securities in the short term in hopes of making a quick profit. So why does long-term investing matter? Long-term investing can offer many advantages such as compounding, diversification, lower taxes, and reduced trading costs. As Charlie Munger once said, the big money is not in the buying and selling, but in the waiting. By buying and holding quality stocks or bonds, you allow your money to grow over time, and you reduce your exposure to market fluctuations. Munger's investment philosophy involves looking beyond short-term economic fluctuations and seeking out exceptional companies with great products and excellent management. To make a long-term investment, you need to understand the company's fundamentals. It's also essential to avoid common mistakes that investors make, such as chasing hot stocks, timing the market, and overreacting to news or rumors. Instead, set realistic goals, stick to a budget, and have a long-term plan. When market downturns or volatility occur, buy more stocks or bonds when they are cheap. Rebalance your portfolio periodically and avoid emotional decisions. Bonus. Thank you for making it this far on the video. And as promised, I'll be giving some bonus tips on how to become successful investors. One of the key lessons that Munger teaches is the importance of avoiding self-pity. He believes that self-pity is one of the most detrimental mindsets that an investor can have, as it can lead to a lack of discipline and a sense of entitlement that can be disastrous for your investment portfolio. Munger himself has faced many challenges in his life, including the death of his son, but he never allowed himself to feel sorry for himself. Instead, he remained focused on his goals and worked hard to achieve them. Self-pity can cause you to become complacent and lose sight of your goals. It can lead to a lack of discipline and a tendency to make impulsive decisions based on emotion rather than reason. This can be especially dangerous in the stock market, where emotions can lead to irrational decisions and huge losses. To overcome self-pity, it's important to cultivate a positive mindset. This means focusing on your strengths, staying motivated and disciplined, and learning from your mistakes. Munger believes that a positive mindset is essential for success in investing, as it can help you stay focused and motivated even during challenging times. So, how can you cultivate a positive mindset when it comes to investing? Well, there are a few practical things to take note of. First, set realistic goals for yourself and work hard to achieve them. This will help you stay focused and motivated even when things get tough. Second, stay disciplined and avoid making impulsive decisions based on emotion. Third, surround yourself with positive people who will support and encourage you along the way. It's also important to learn from your mistakes and move forward. Successful investors like Warren Buffett and Charlie Munger have made plenty of mistakes along the way, but they have always learned from them and used them as opportunities to grow and improve. By adopting the same mindset, you can turn your failures into valuable learning experiences that will help you succeed in the long run. As we wind down, be sure to check our other videos on this channel about making money and investing. Learning is the key to earning. And as always, if you have any questions or comments, feel free to leave them below. Thanks for watching, and we will see you in the next video.